Hi, and thank you for watching Tax Talk UK, where we talk about all things tax and cover other important aspects of working for yourself, being self-employed, running a small business. So today we're going to look at what happens from a capital allowance perspective when you come to sell an asset that you've previously claimed for. So before we talk about that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you will easily be able to refer back to this video if you should need to, as well as being able to navigate your way to the other videos that we have on a whole wide range of topics, all aimed at supporting you in your self-employment. And you will find them all catalogued per your employment type or your trading style in our playlists. So back then to assets and selling an asset. So we've talked previously about the options when you first purchase an asset and having the option to claim an annual investment allowance, therefore offsetting the whole cost of the asset against your profit in that one whole year and reducing your tax, or using depreciation where you depreciate your asset on a fixed percentage each year and roll the amount forward in what we would call the net book value. So you start with your asset value, and then you depreciate at 18%. And then whatever's left, the difference between that goes into the next year is the net book value. And in year two, that is the amount that's depreciated at 18%, and so on and so forth. And that obviously the aim of that is to spread the cost out over some years. And obviously when we talk about which way is the best for you, because of course there's nothing wrong with you do which is best for you, which is the most tax efficient for you, annual investment allowance or depreciation. Ultimately, in the whole time that you own the asset, you're going to pay the same, or you're going to claim the same amount for the asset, whichever way. It's just about whether you have that full cost allowed up front, or whether you spread it out. Now, one of the factors that we say to take into consideration when you're deciding, when you first purchase the asset, when you're deciding how to claim and the method that's going to be best for you, is to consider what happens when you sell the asset. Of course, if you are in the situation of now selling an asset, then you need to know the tax implications for you. So that is what we're going to look at now. So we're going to use an example, and I am just going to switch to a slideshow. So we purchased an asset for £15,000 in this example. So at the end of the first year, in this scenario, we are going to show the net book value after 2 years. But of course, you do have the option to claim an annual investment allowance of the £15,000 in year one, therefore offsetting the full cost of the asset in that first year. So taking £15,000 off of your profit in that first year. And of course, that may have been what you've chosen to do. But if you've depreciated, then at the end of year one, you're going to claim a capital allowance of £2,700 against your profit for that year. And that is going to leave you with a net book value of £12,300. So if you remember, and we've talked about this in other videos, the net book value isn't an actual value. It's not saying that that asset is now worth £12,300. It's just saying for tax purposes, that's what you haven't claimed. Is a simple way to think about it. So the amount still to be claimed. So that is so going into year two, we start with a net book value of £12,300. Now, in the end of year two, we are going to claim 18% again of the net book value. So this year we're going to claims slightly less, of course, because it's of a reduced net book value. We're going to claim £2,214 capital allowance. So this then gives us a net book value of £10,086. So as you can see, so by the end of year 2, we have claimed £4,914 of the 15,000, and we've still got £10,086, which we haven't claimed. So let's say, for example, that in year 3, we sell the asset. Let's say we sell it for £8,000, for example. Now, if you'd have chosen at the start to have claimed the annual investment allowance, in year 1, you claimed the full 15,000 against your profit. So therefore, you have completely claimed the full cost of that asset. And when you now receive the £8,000, that of course now becomes income. So that then adds to your profit and becomes taxable. And the reason being is because although you spent the £15,000 in the first place, you fully had tax relief for the 15,000. So now anything that you receive from the sale of that asset now is income. So if you claimed an annual investment allowance, regardless of what point you sell the asset, it will all be all effectively add to your profit and become taxable. Now, if you've depreciated and you entered year 3 with a net book value of £10,086, and you sell the asset for £8,000, then we will take the 8,000 off of the 10,086 net book value, and then you can see there's still £2,086 of that original 15,000 that we haven't yet had tax relief from. So and you can see that the other way as well. So if you take the 15,000 that you originally paid out, take off the 8,000, because you've got that actual money back in the sale of the asset, and that leaves us 7,000, and we've only claimed 4,914. So you can see there we've still got £2,086 of that original cost that we still need to claim. So that would be the scenario if we're selling it for less than the net book value. But let's say, for example, if we sold the asset for £12,000 in year 3. So again, as I mentioned earlier, the net book value is just the amount that hasn't been yet claimed, is a way to think about it. It's not necessarily relative to the actual value of the asset. So it's often would be expected to be the case that you won't get exactly the net book value, because that's not what the net book value is intended to do. So going back to the scenario then, in year 3, we sell the asset for £12,000. Now, again, going back to if you initially claimed an annual investment allowance for the £15,000, then that whole £12,000 is added to your profit in its entirety, because you've already had full tax relief for the full 15,000 that you spent out. So now you've had that £12,000 in. That all effectively becomes income for the business, so it gets added to the profit. It's not actually treated as income in your turnover, but in theory, that is what's happening to it. So going back then to if you've depreciated your asset, and at the end of year 2, you've ended up with a net book value, you've gone into year 3 with a net book value of £10,086, and in year 3 you're selling the asset for £12,000, then you can see in this scenario effectively £1,914 is going to be added back to your profit, because you've had tax relief for 10,000, you've still got tax relief, sorry, for £10,086 to claim, but you've actually received more than that, £1,914 more than that. So that's going to get added back to your profit. So effectively, in order to know the tax implications of selling an asset, you need to go back to how you've decided to treat it. So if it's an annual investment allowance that you've decided to treat that asset when you first purchased it, when you come to sell the asset, any profit that you make, any income that you get for that asset now gets added to your profit. If you have gone for the depreciation method, what you need to do is compare the net book value, so not the actual value, the net book value, i.e. the amount that you still haven't claimed of your original outlay, and you compare that with the amount that you received, and that is when you see whether you need to assess whether there's still more to claim, or whether you've already claimed more now than you had when you take the original purchase less what you got for it. So going back to the scenario where we sell the asset for £12,000, so we originally purchased the asset for 15,000, so we paid out 15,000 and we've had 12,000 back in. So our actual cost now, the money that we've actually had to spend, is £3,000, but we've actually claimed a capital allowance of 4,914. So now you can see why that 1,914 effectively we've got to undo that that tax relief on that amount. So of course, when you come to do the tax return, and we'll talk about this in other videos, there's sort of jargon that's attached to it. But in this video, I just wanted to give an actual overview and understanding without using jargon of what is actually happening and why you are taxed on certain amounts and how you work out what those amounts, and also so that you can plan through the course of your the life of your asset, so you know what's going to happen when you come to sell the asset. Because of course this is really important for your financial planning. You need to know, obviously you're going to know what you're going to expect to sell that asset for, but it's also important to know the tax implications, because if you're banking on having a certain amount from that asset sale and you're going to have a tax liability arising from that, then you need to know that so that you can include that into your cash flow forecasting. So hopefully that helps you to understand what happens from a tax perspective at the point that you sell your asset. And as I say, we'll look in other videos about actually completing the self-assessment tax return. But just as I say, this is just really so that you can understand what will actually happen, as opposed to how to complete the form with what has happened. If you have found this information useful, please do take a moment to like the video. That is really helpful for us to help us to understand what topics people are finding the most useful, and what sort of level of detail people are finding the most helpful. And as I mentioned earlier, please do also subscribe to our channel. Thank you very much. Goodbye.